In this video, I want to show you what I use in my trading and how you can apply it in practice. Over the past week, I earned more than $18,000 on the Year 40 index using just one setup. And let me say straight away, this approach works not only on indices. It can be applied to any market, whether it's currency, gold, or crypto. The main thing is to understand the logic and strictly follow all the rules. Everything I'm going to show you is as simple as possible, but that simplicity is where the stability lies. When you stop looking for complex signals and focus on just one setup, you start to see the market the way the algorithm sees it. In my trading, I use only three elements: liquidity, fair value gap as the main area of interest, and session timeframes. And I should mention that I do not use any other zones, because these three elements provide everything you need to understand the structure and logic of price movements. I'll discuss each of these elements in more detail so that you have a clear understanding of how I analyze the market and what I look for on the chart before entering a trade. First, let's talk about liquidity. I think most people already know what it is. If not, I have a special video on my channel where I break down the mechanics of liquidity and explain why it plays a key role in price movement. Here, I want to touch on one important point. When you work with liquidity, for example, waiting for yesterday's liquidity to be withdrawn, it's important to look not only at the fact of the withdrawal itself, but also at the price reaction after that. It's this reaction that shows whether there is really interest from the algorithm in this zone. Because initially, you cannot know whether there will be a reaction from the level or whether the market will simply withdraw liquidity and continue moving forward. So the key is not liquidity itself, but how the price behaves after its withdrawal. Most often, it's at this moment that you realize whether it's worth working from this zone or whether it is better to skip it. At the very beginning, I always look at where the fair value gap is on the higher time frame, H4 or H1. This helps to understand the context and determine where a strong reaction may occur. To make it clear, let's look at a specific example. By the context of the chart, we are in a short position. Below, there are targets for liquidity withdrawal and two fair value gaps formed during yesterday's New York session. There has already been a reaction from the closest one. This movement has just removed some of the liquidity. But from the upper one, which was left unprocessed, we are getting a reaction for the current day. At the same time, a new fair value gap is forming at the moment of movement, already within the current session. When I see that the zone is strong, I switch to a lower time frame, usually 3M or 5M, and wait for local liquidity to be withdrawn before this fair value gap during the Frankfurt or London session. If there is a reaction after the withdrawal and the structure confirms the movement, I enter the trade. I set a stop for the invalidation of my idea, where the scenario becomes invalid. Take profit at the nearest liquidity zone. This could be the Asian low or the PDL of the previous day. We have already removed the first target in the form of the Asian low, but the targets below still remain. Since we have a short context, I continue to look for trades in the same direction. Now I'm showing the same day. I just want to explain how you can continue working within the New York session. Often it is New York that removes the liquidity of the previous session. In this case, the price took the low of the Asia session, after which it is logical to expect the price to be delivered to the fair value gap in order to continue moving down from there. And here it's important to understand the idea itself. Not every fair value gap is suitable for trading. But if you see that the price gave a reaction, the context remains directional, and there are targets below for liquidity withdrawal, then you have a scenario with a high probability of execution. After the price is delivered to the desired area, I switch back to the lower time frame and look for a reaction, just like in the previous example. In this case, you can see how building liquidity is forming, which becomes additional confirmation for entry. Same as before, I set a stop for the invalidation of my idea and a take for the next liquidity zone. The main thing here is not to try to catch every movement. You need to wait until the structure, context, and reaction coincide. Only then does the trade make sense. And one more thing, if the price doesn't react to the fair value gap or breaks through it without signs of a reversal, it's not a missed opportunity, but money saved. In trading, it's not the number of trades that matters, but the quality of confirmations. Now, I want to analyze one of the last trading days, where I managed to make a profit of about $16,000, so that you can understand better what variables I use and how I look at each session step by step. But before that, it makes sense to explain to you why I didn't trade the previous day. Many people ignore this point and end up entering the market every day, even when conditions are not right. On that day, the problem was that there were too many zones of interest. In such situations, I always move to a higher time frame, H4. There, we saw a reaction from one zone, but there was still another zone above it where the price could also go before continuing its movement. Therefore, I deliberately skipped that day. It's important to mention that all the movement that day ended up being a perfect rebalancing. The price went back to the zero point 0.5 area and formed liquidity that I could work with the next day. So, how did I look at the market on the day I entered the trade? The first thing I saw when I opened the chart was the withdrawal of liquidity from the PDL, the previous day's low, and from the large liquidity pool that had formed earlier. In addition, we got a clear reaction to this zone and a fair value gap formed, which could be used later in the Frankfurt or London sessions. Nothing interesting happened for me in Frankfurt, but there was a very interesting movement in the London session, which is why I wanted to analyze this day in more detail. The first thing that happened in London was the withdrawal of local liquidity before our zone of interest. This was a perfect continuation of the plan. After that, the price reacted, and I opened a trade at this point. Then the price went higher, removed liquidity from above, and entered a short fair value gap, which triggered a resweep. 2 points are important to note here. First, my initial scenario was to go long because we already had a significant withdrawal of liquidity from below and a reaction to it. The pool we took at the bottom was much more important than the local short fair value gap above. So I deliberately ignored this fair value gap and continued to stick to my idea. Second point, if I had focused only on the lower time frame, my trade would have been knocked out by a stop loss on a resweep, and then the price would have gone straight to my take profit without me. But since the stop was tied to the zone on the higher time frame and stood for the invalidation of the idea, the trade held up and worked out as planned. So remember, if you use this setup, always focus on the higher time frame when setting your stop. All logic is based on context, not on a single candle on M1. If you start looking at the market through the combination of context, liquidity, fair value gap, and session times, and at the same time remove everything unnecessary, your trades will become less frequent but more accurate, and as a result, much more profitable. As you can see, I only had 3 trades during the whole week, and I am deliberately showing you not only the profitable ones, but also the unprofitable ones, because it's not the result of a single trade that matters, but the fact that they were all made strictly according to the same setup. The unprofitable trade was influenced by a news factor. Trump decided to make another statement on tariffs, and at such moments, the market goes beyond normal logic, so I will not objectively evaluate it in the context of the system, but it is precisely such situations that show how important it is to have a clear algorithm and not make decisions based on emotions. If you still find it difficult to understand the structure, understand price behavior, or simply don't have enough time, you can use the Howell indicator. Important, OWL doesn't work with liquidity, and it's not related to the smart money approach. It's a standalone system, trend-based, with a clear risk management and understandable conditions. No guesswork, no manual marking. The indicator itself determines the entry point, stop, and take, strictly according to its logic. It works in any market, forex, gold, crypto, and is suitable for those who want to trade with the trend but without complex analysis. And if you want to get the OWL Helper Expert Advisor, just message me on Telegram. Hi, send me the OWL Helper Expert Advisor. I bought the indicator and the date of purchase. You can find the link to the indicator in the description below the video. It's also important to understand that this setup is universal. It works in any market. Even if we take Bitcoin and its recent drop in the news, it's not chaos, but a natural movement that, like any other, had its own goal. If you understand the mechanics of liquidity and fair value gap, you can see that even such sharp impulses could be calmly traded according to the same rules. And now briefly on where I trade crypto myself. I use Evedex, a decentralized exchange with a simple interface, fast execution, and minimal commissions. There are no verifications, limits, or restrictions here. Just connect your wallet and trade. If you trade based on structure, understand manipulation and price movements, Evedex gives you everything you need for systematic work. The link to the exchange is in the description below this video. Now let's finalize. Everything you saw in this video is not magic or perfect entries. It's the same setup, repeated day after day. Context, liquidity, fair value gap, and session times are the 4 variables that form my trading logic. The point is not the amount of profit, but the system. Money is just a consequence of the right actions, not their goal. The most important thing in trading is to find your setup and work on it systematically, without rushing, without emotions, without the need to guess the market. This is discipline, the line that separates a trader from a gambler. The market always reflects your state of mind. When you are calm, have a plan and a system, it becomes predictable. When there is chaos inside, the market turns into chaos. One setup, one logic, one plan. and everything else becomes a pattern over time, not a coincidence.